Kia ora, everyone. I'm Debbie Roberts from Property Apprentice, and this was the week in review for 28th of June to the 4th of July 2026. First up for this week, from good returns on the 28th of June, ANZ still expects 3 OCR rises this year. This article was published before the OCR announcement on the 8th of July, and wow, a lot can happen in a short time frame these days. But despite a sudden and unexpected drop in global oil prices following a memorandum of understanding between the US and Iran, which is all obviously now up in the air again following an apparent end to the ceasefire, ANZ economists are still expecting the Reserve Bank of New Zealand, the RBNZ, to hike the official cash rate by 25 basis points, which they did. And then they're still expecting subsequent hikes in September and October, taking the cash rate to a neutral 3% position. And the RBNZ was already forecasting 3 cash rate hikes before the temporary oil price spike occurred, meaning that the low starting point of the OCR remained the primary driver for monetary policy tightening. Lower oil prices were expected to help cool near-term inflation and buy the central bank more time, but they don't eliminate the structural need for higher interest rates as growth and consumer confidence rebound. ANZ shifted its forecast to expect an outright 2% decline in national house prices this year, driven by rising interest rates, substantial tax uncertainty ahead of the general election, and the lagging economic drag of the recent oil shock. The housing market has recently sat on a largely flat path because while buyers have stepped back, many sellers have also hit pause, preventing immediate severe downward pressure on prices. On the mortgage front, wholesale interest rates fell following the de-escalation in the Middle East, leading to recent short-term mortgage rate cuts by several retail banks. So my thoughts on this are that the important thing to remember here is that predictions often prove to be useless in hindsight. Remember how economists all around the world expected economies and housing markets to collapse during the global pandemic, and then the absolute opposite happened. So will we see a 2% dip in house prices? Here's what I think. Remember that some parts of the country, like Christchurch, for example, are actually having price increases at the moment. So don't get hung up on the averages or the medians when it comes to capital growth or price dips. You've got no control over capital growth, but the fundamentals still hold true. Property investing is a long-term investment strategy, and we certainly expect to see long-term capital growth. The fact of the matter is that at the moment, you can make your money when you buy by negotiating on the purchase price and or adding value to the property that you purchase. If values fall further in the short term, you've already built in a safety buffer by doing that. But more importantly, when the market does start to increase in value again, and it absolutely will, you'll feel like a genius if you bought well in the current market. It's not about getting your timing right, because it's next to impossible to do that when it comes to investing. It's more about taking action when you can to buy the right sort of property for your current financial position and goals, and holding on to that property for the long term. At the end of the day, if values fall, you'll only lock in the loss if you sell the property when your value's down. I'll discuss the OCR announcement in more detail in the next week in review, but I'm sure you'll be aware that the RBNZ did indeed increase the OCR by 25 basis points on the 8th of July. And meanwhile, everyone enjoyed the reduction of prices at the petrol pump, at least for a short term. But let's hope that lasts. Some retail banks responded quickly by trimming their short-term interest rates as the market had already priced in these moves. But we'll see what happens next with fuel prices and the Iran conflict re-escalation. Topic number 2 from times.co.nz on the 2nd of July. June was the most active month in housing market in 6 years. Realestate.co.nz reports that June 2026 was the busiest month for property vendors since 2020, signalling that New Zealanders are no longer pausing transactions to wait for domestic, economic or geopolitical uncertainty to pass. Nationally, New listings rose 4.3% year on year to 7,942 in June, while total available stock climbed 7.3% to 34,761 properties, providing highly favourable and relaxed conditions for active buyers. Canterbury has emerged as the country's leading regional success story at the moment for capital growth, hitting an all-time record average asking price of $757,136. That's an increase of 5.2% year on year, marking its second record high in 2026 after hitting $736,421 in April. Canterbury's price growth represents a fundamental transition from a recovering earthquake zone a decade ago to a region characterised by high livability, major infrastructural projects such as the Te Kaha 1 New Zealand Stadium, and strong population growth, 6.07% between 2020 and 2025. On a national basis, average asking prices have remained locked in an exceptionally flat corridor between $840,000 and $890,000 for 3.5 years, indicating a prolonged phase of macroeconomic stability. Highly localised dynamics are driving regional listings and inventory. Central Otago and Lakes District remains the most expensive region, with average asking prices of $1,605,575. That's an increase of 6.5% year on year, while the volatile Coromandel market fell 13.9% year on year to $996,260, dropping below the $1 million mark for the first time since September 2025. My thoughts on this are that there's a sense of momentum returning to the market. People are realising that waiting for a perfectly predictable market is a myth, and they're choosing to get on with life and achieve their property goals, whether it's buying or selling. Look at Canterbury. It's absolutely thriving, with another record high average asking price of over $757,000, backed by a strong local economy and incredible new infrastructure like the Te Kaha Stadium. While national prices have stayed remarkably steady and flat for over 3.5 years, providing a safe and stable environment, the real action is happening at the local level. Southland is experiencing a solid absorption phase, with listings up nearly 25%, but overall inventory dropping because buyers are snapping houses up faster than they're being listed. With over 34,000 homes available across the country right now, buyers are in an amazing position. You've got the time, the choice, and the negotiation leverage to secure a fantastic property on your terms without the stress of intense, frantic competition. It's important to remember that people will always want to buy property, but in times of uncertainty, most people sit on the sidelines waiting for things to become more certain. History shows us that counter-cyclical investing pays off in spades. If you're in a position to take action now, while most people are waiting for more certainty, you will reap the rewards. When others start to feel more confident and enter the property market, will all of their pent-up demand from sitting on the sidelines impact on property values? In my opinion, yep, and it could be dramatic. We're currently on track to having the longest downturn in the property market since the early 1970s, and values certainly picked up following that downturn. History has a funny way of repeating. Just saying. Topic number 3 from RNZ on the 30th of June. Here's where housing's most affordable and where it's becoming more. Massey University's Q1 2026 Home Affordability Report shows a major 12.6% improvement in national housing affordability over the first 3 months of the year. This quarterly improvement was driven by a highly favourable trifecta: a drop in median house prices across many regions, declining mortgage interest rates, and a steady increase in household incomes. On an annual basis, national housing affordability surged by an extraordinary 23.1%, fueled by a 1.37 percentage point drop in 2-year fixed mortgage interest rates and a 3.49% increase in average weekly earnings, easily outpacing a modest 3% annual rise in median house prices. Median house prices fell in 8 out of the 16 regions tracked, led by a steep 11.5% contraction in Marlborough, which subsequently recorded the country's most significant quarterly affordability improvement of 21.7%. Northland led the country in annual affordability improvements with a 32% lift, closely followed by Auckland at 25%, Wellington at 24.3%, and Canterbury at 23.4%. The West Coast of the South Island recorded the smallest quarterly affordability lift at 5.5%, but remains New Zealand's most affordable market overall, while Auckland continues to rank as the least affordable. Report author, senior lecturer Ashad Javid, noted that the widespread reassessment of rateable values, or RVs, across most regions during 2024 served as a critical catalyst for bringing down vendor price expectations and correcting overall values. Javid issues a critical forward-looking warning. Any potential increases to the official cash rate by the RBNZ in future monetary policy announcements could lift mortgage rates and quickly erode these hard-won affordability gains. Here's my thoughts. This is an absolute green light for home buyers and investors. Massey University's latest report shows a 12% increase in housing affordability in just 3 months and a whopping 23% improvement over the last year. Why isn't this being talked about more by mainstream media? This is great news, but I guess news doesn't grab people's attention. Good news doesn't grab people's attention like the bad news does, right? I mean, you're probably still thinking about my last comment regarding how potential increases to the official cash rate could lift mortgage interest rates and erode the affordability gains. Am I right? We're currently in the ultimate window of opportunity for the New Zealand property market, but history shows that most New Zealanders will completely miss it. Regions like Marlborough and Northland are seeing spectacular leaps in affordability, and even major centres like Auckland and Wellington have improved by around 25%. Although if you're a home buyer in Auckland, you probably only heard the part about how Auckland continues to rank as the most unaffordable region in the country, right? While these conditions are highly favourable right now, they won't last forever. This is your cue to take action. If your household income's steady, you've got a rare opportunity to step in and secure a great deal before the market enters into the next growth phase. If you're getting value out of this podcast, please open up your Apple Podcasts or Spotify app right now and hit that follow button. It's the number one way to help us help more first-time buyers and property investors gain access to quality content. If you want to learn more about investing, join me at one of our free online sessions called How to Succeed with Property Investing. In these events, we focus on helping you to increase your knowledge to reduce your risk. As a financial advisor and experienced investor, I'll help you to navigate the current market with more confidence in order so that you can make smarter decisions. They're live, online, and Property Apprentice is independent because we don't sell property. Go to propertyapprentice.co.nz to register for the next free event. Topic number 4 from One News on the 1st of July, major bank lifts some mortgage rates and slashes others. ASB announced a series of split direction rate adjustments, lowering its longer term mortgage rates while simultaneously increasing 2 of its shorter term rates. Rate increases for borrowers with at least 20% equity. ASB raised its 6-month mortgage term by 20 basis points to 4.69% and its 18-month term by 14 basis points to 5.09%. Rate decreases for borrowers with at least 20% equity. The bank lowered its 3-year rate by 20 basis points to 5.29%, its 4-year term by 20 basis points to 5.49%, and its 5-year term by 30 basis points to 5.59%. Remember, these are the publicly advertised prices as well. Borrowers with less than 20% equity will face additional low equity margin pricing on top of these standard rates. With deposit changes, ASB also adjusted its term deposit pricing downward, lowering its 24-month, 36-month, 48-month, and 60-month term deposit rates by between 10 basis points and 25 basis points. This pricing adjustment mirrors highly volatile international wholesale interest rate markets and represents the second major retail bank repricing of the week, closely following Kiwibank's adjustments. These strategic commercial adjustments came directly ahead of the Reserve Bank of New Zealand's highly anticipated OCR announcement on Wednesday, the 8th of July, as this announcement was made on the 1st of July. So my thoughts are we're seeing lots of movement from banks with interest rates at the moment, and it pays to remember that banks will continue to focus on where their pricing sits in comparison to other banks so that they can remain competitive enough to attract your business. If you've got better things to do with your time than shopping around all the banks to see who'll give you the best deal, it's time to talk to a mortgage advisor. It costs you nothing because they get paid by the banks when you settle a mortgage. But mortgage advisors work for you, not for the bank. So they got your best interests at heart and they'll help to make sure that you get the best possible deal. Topic number 5 from RNZ on the 2nd of July. Third of those declined emergency housing not offered any alternative. A third, well, not quite a third, 30% of individuals were declined for emergency housing in New Zealand and not offered any alternative housing support, such as transitional housing, social housing, rent arrears support, or private rental bond advances due to strict eligibility assessments. Following policy directives established 2 years ago, emergency housing has been classified as a strict last resort, with the Ministry of Social Development, MSD, implementing performance targets for managers to actively reduce emergency housing numbers. While MSD claims 70% of declined applicants are offered alternative support, the department doesn't track or monitor the living arrangements or welfare of the remaining 30% who are turned away without assistance. Upon being questioned by Chris Hipkins, Christopher Luxon repeatedly pointed out the other alternatives that were offered to those in need, stating that if someone doesn't qualify for emergency housing, they might still qualify for transitional housing, social housing, rent arrears support, or find a private rental property. In parliamentary debates, the government defended its housing record, contrasting its performance against the previous administration by stating housing's more affordable, rents are down, the social housing wait list is down, 2,400 kids are out of squalid, crime-ridden motels, and we're putting a lot of focus on homelessness and rough sleeping. The Ministry of Housing's latest Homelessness Insights report indicates that while rough sleeping in central Auckland has decreased since September, most regional councils nationwide have noticed an increase in unsheltered individuals over the last 6 months. My thoughts on this are that this data reminds us of the incredibly positive and essential role that private property investors play in New Zealand. Because private rentals don't cost the taxpayer anything, it's the cheapest way to house Kiwis who need to rent for a variety of reasons. By building a reliable, well-managed property investment portfolio, you aren't just securing your own financial future, if you do it properly, you're providing real housing solutions that our communities need. Not everyone can afford to buy a home at any given moment in time, even though housing is currently the most affordable it's been in a decade, although everyone certainly needs somewhere to live. It proves that residential property remains one of the most resilient, secure, and socially valuable assets that you can own, giving you a chance to grow your wealth while providing a home for people who aren't yet in a position to buy their own. I want to hear from you in the comments. Are you feeling the improvements in housing affordability and the growth in the economy yet? Or are you still focused on the negativity bias provided by the media? If this breakdown gave you some clarity or the motivation you need to work towards reaching your mortgage and property plans this week, please hit that subscribe button and give this video a like. And if you want to learn more about how to become a successful property investor in New Zealand without risking it all, join me at our next online event called How to Succeed with Property Investing. They're free and online, and you can register now by going to propertyapprentice.co.nz. Thanks for listening. I'll see you in the next episode. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.